Wait, did Trump just drop a tariff bomb on tech? Or was it an April Fool's joke? Because if it's real, it could seriously shake Nvidia's NVDA future. With a price-to-sales ratio over 21 and a PEG ratio above 1, NVDA is already trading like it's in the stratosphere. But what happens if supply chains tighten and costs spike? Will those high margins survive? We dug into every single financial ratio of Nvidia: profitability, valuation, debt, cash flow, you name it. And trust me, there are some surprises.
Do you think the U.S. should back off on China trade sanctions? Do you think the restrictions are effective?
Well, we have to defer all of the policy making to the administration. They understand that the balancing national security versus the prosperity of American technology all over the world. We're exporting American technology, which is really terrific for the United States. That the world is built on Nvidia, on American standards. Nvidia is an American company, and our government and the administration would love to see us succeed. And so, finding the right balance is very difficult to do, but they're doing a wonderful job.
Is NVDA too hot to touch now, or is this just the beginning of something even bigger? Let's break it down. Has Nvidia's reign as the AI chip titan hit a wall? With their earnings dropping soon, the stakes couldn't be higher. Will they crush it, or are cracks starting to show? You won't believe what's at play. Stick with me to find out.
Hey everyone, welcome back to the channel. Today we're unpacking Nvidia's fourth quarter earnings report, set to hit after the bell on Wednesday, February the 26th. This is a big one for investors and tech fans alike. We're talking supply chain chaos, policy curveballs, and a new rival shaking things up. Plus, I've got a trading tip that could line your pockets, if you play it right. Before we dive in, hit that subscribe button and ring the bell so you never miss a market update. Let's jump in. First up, supply versus demand. Nvidia's AI chips are the backbone of the tech boom. Think data centers, AI breakthroughs, you name it. But demand is through the roof and supply, not so much. We've seen giants like Microsoft, Google, and Amazon stumble on revenue because they couldn't get enough chips. Now, Wall Street's eyeing $38.2 billion in revenue for Nvidia this quarter. That's a tall order if they can't deliver the goods. Nail it, it's a home run. Miss it, investors might hit the panic button. What's your take? Can Nvidia pull it off? Drop your thoughts in the comments. Hang tight, because next we're tackling a policy twist that could flip Nvidia's game upside down. The US is throwing punches at Nvidia's global reach. The Biden crew already banned their AI chips from China, and Trump's team might double down to boost US chip making. Then there's the tariff bomb. President Trump floated a 25% tax on chips. Picture this: Nvidia's high-end chips could jump hundreds of bucks overnight. Do customers fork over the cash? Or does Nvidia swallow the cost and watch profits tank? It's a tightrope walk, and the fallout could be massive. A 25% tariff could tack on $500 to some of Nvidia's priciest chips. That's enough to make your jaw drop, and maybe their stock too.
Looking ahead, it's all about Nvidia's next moves. Their Blackwell chips, fancy next-gen tech, are the talk of the town. Investors are dying to know when these will take the wheel and juice up data center revenue. The catch? Timing's everything, and delays could rattle the cage. Then there's DeepSeek, the scrappy upstart using Nvidia's own chips to train cheaper AI models. Sneaky, right? It's proof Nvidia's king of the hill, but it also means the competition's heating up. Can they stay on top? We'll dig deeper in a sec. Analyst Sarah Lee from TechPulse says, Blackwell's a beast, but execution's the key. Any hiccups could open the door for rivals. Meanwhile, Mark Chen from Investor Edge counters, DeepSeek's a blip. Nvidia's ecosystem is untouchable. What do you think? Threat or hype? Finally, let's zoom out to the market. Nvidia used to be the market's golden child. Last year, it drove 20% of the S&P 500's gains. This year, just 5%. The rally's spreading out. Walmart, JP Morgan, even Eli Lilly are stealing the spotlight. Nvidia's stock is up 3.3% year-to-date, but it's off its January 6 peak. Revenue growth still solid at 73%, but it's a far cry from the 260% rocket ride of 2023. Options traders are betting on a 7% swing post-earnings. That's $240 billion in market cap on the line. Will it spark a surge or a slump? Maybe neither. just a slow grind over weeks. Either way, it's not the one-day blockbuster it once was.
Here's a comprehensive data analyzing Nvidia's NVDA financial performance using key financial ratios. So now let's dive deep into Nvidia's financials to understand how the company is performing. We'll break down key financial ratios to see what they tell us about Nvidia's profitability, efficiency, liquidity, solvency, valuation, and growth. Let's get started. For the profitability ratios, gross profit margin. Nvidia's gross profit margin stands at approximately 75%. This means that for every dollar of revenue, Nvidia retains 75 cents after covering the cost of goods sold. A high gross margin indicates strong pricing power and efficient production. Operating profit margin. The operating profit margin is around 62%, showing that Nvidia retains 62 cents in operating income for every dollar of revenue. This reflects effective management of operating expenses. Net profit margin. With a net profit margin of about 56%, Nvidia converts 56% of its revenue into net income. This high margin underscores the company's profitability. Return on assets, ROA. Nvidia's ROA is approximately 85%, indicating that the company generates 85 cents of profit for every dollar of assets. This suggests highly efficient use of assets. Return on equity, ROE. The ROE stands at about 126%, meaning Nvidia generates 1.26 times in profit for every dollar of shareholders' equity. This high ROE reflects strong financial performance and effective use of equity. Return on capital employed, ROCE. With a ROCE of around 105%, Nvidia efficiently uses its capital to generate profits, indicating strong operational efficiency. The EBITDA margin is approximately 64%, showing that Nvidia retains 64 cents in earnings before interest, taxes, depreciation, and amortization for every dollar of revenue. For the efficiency ratios, Nvidia's asset turnover ratio is about 0.7, meaning the company generates 70 cents of revenue for every dollar of assets. This indicates moderate efficiency in using assets to generate sales. Inventory turnover. With an inventory turnover of around 5, Nvidia sells and replaces its inventory 5 times a year, suggesting efficient inventory management. Receivables turnover. The receivables turnover ratio is approximately 12, indicating that Nvidia collects its average accounts receivable 12 times a year, reflecting effective credit and collection processes. Days Sales Outstanding, DSO. Nvidia's DSO is about 30 days, meaning it takes the company roughly a month to collect payment after a sale, which is a healthy time frame. Days Inventory Outstanding, DIO. The DIO stands at around 73 days, indicating that Nvidia holds its inventory for about 2.5 months before selling it.
For the liquidity ratios, current ratio. Nvidia's current ratio is 4.44, suggesting that the company has $4.44 in current assets for every dollar of current liabilities. This indicates strong short-term financial health. Quick ratio. The quick ratio is 3.67, showing that even without considering inventory, Nvidia has $3.67 in liquid assets for every dollar of current liabilities. Cash ratio. With a cash ratio of approximately 2.5, Nvidia has $2.50 in cash and cash equivalents for every dollar of current liabilities, highlighting excellent liquidity.
For the solvency ratios, debt-to-equity ratio. Nvidia's debt-to-equity ratio is about 0.26, indicating that the company uses 26 cents of debt for every dollar of equity, reflecting a conservative capital structure. Debt-to-assets ratio. The debt-to-assets ratio is approximately 0.17, meaning 17% of Nvidia's assets are financed through debt. Interest coverage ratio. With an interest coverage ratio of 333.96, Nvidia earns over 333 times its interest obligations, showcasing a strong ability to meet debt payments. Equity ratio. The equity ratio is around 0.83, indicating that 83% of Nvidia's assets are financed by shareholders' equity, which is a sign of financial stability. Financial leverage ratio. Nvidia's financial leverage ratio is about 1.2, suggesting moderate use of debt in its capital structure.
For the valuation ratios, Nvidia's PE ratio is 37.00, meaning investors are willing to pay $37 for every $1 of earnings. reflecting high growth expectations. The forward PE is approximately 30, indicating that based on expected future earnings, the stock is slightly cheaper than its current PE suggests. With a PEG ratio around 1.2, Nvidia's stock price is slightly higher relative to its earnings growth, but still within a reasonable range. The PB ratio is about 25, showing that the stock trades at 25 times its book value, which is high and suggests strong investor confidence. Nvidia's PS ratio is 1.04, meaning investors pay $21.04 for every $1 of sales, indicating high expectations for future growth. With a PFCF ratio of around 35, the stock is priced at 35 times its free cash flow, which is high but may be justified by growth prospects. The EV/EBITDA ratio is approximately 30, suggesting that the stock is valued at 30 times its EBITDA, indicating a premium valuation.
Now, here's where it gets juicy. Using discounted cash flow, Nvidia's fair gap value sits between $69 and $102 per share. Current price? $110. That's overvalued by about 8% if we peg the top end at $102. So what's the move? If you're holding, chill for now. Buying? Wait it out. I'd say snag it at $82, smack in that fair value zone, and flip it at $100 for a tidy short-term gain. Want to dive deeper into trades like this? Check out am-am.com for killer tools and insights. But heads up, this isn't advice, so do your homework. Before we wrap, I've got a wild story about an investor who flipped Nvidia's last earnings for a 15% win. Stay tuned! Last earnings, Nvidia's stock dipped 5% on supply worries, but buyers swooped in and it climbed 10% in weeks. Lesson? Volatility's your buddy if you time it. Could history repeat? Keep watching to prep your plan. Let's hit some FAQs. Long-term buy? Nvidia's AI lead says yes, but risks loom. How do they cash in? Chips for gaming, AI, and data centers. Biggest risks? Supply snags, tariffs, and DeepSeek's rise. More questions? Hit the comments, I'll reply. There you go, Nvidia's earnings in a nutshell. Watch supply, policies, and that DeepSeek twist. Whether you're trading or investing, stay sharp. For more edge, swing by am-am.com to level up your game. Loved this? Smash that like button, share it with your crew, and subscribe for more. Next time, we're cracking another hot stock. See you then.